Our guest this week is Itamar Novick, founder of Recursive Ventures. Itamar is a solo capitalist with a focus on pre-seed startups built around data and AI. We talked about the opportunities and challenges that AI presents, anti-patterns to avoid in startups, winning deals, and why Itamar thinks that most VCs do not add value to startups. Itamar has been a founder, executive, and investor, so this is a really thoughtful, nuanced conversation. Please enjoy. Itamar, thanks for coming on the show.
Thanks for having me, Joe. Very excited to be here today.
I think this will be a fun conversation. There's a lot of stuff I want to chat with you about. I want to start with a series of posts that you've had on your blog going back a while. And they're about anti-patterns. And I thought that a good way to get rolling would be for you to talk about anti-patterns, and then we can talk about some specifics, but maybe kind of introduce that topic.
I love this one. You know, startup anti-patterns is very dear and near to my heart. Being both an entrepreneur and investor, I've been in startups for 25 years. And learned a bunch about startups kind of the hard way. And one of the things that I learned is that there is no single recipe for success. Right? It's like very hard to reproduce success. Every successful company, every unicorn or whatever you want to consider a success has had its own unique journey to get to where they've gotten. However, the patterns of failure in startups are actually repeatable. And also, obviously, most startups fail. They're not successful. So there's actually a lot of data to pick up and understand what kind of led to those failures. So startup anti-patterns are actually anti-patterns in the sense that those are things, I've jotted down 75 of them, things that you, in your startup as a founder, you might think, oh, this is a great idea, right? I should do anti-pattern X and Y. But actually, those things in the mid or long term can cause significant harm to your startup, potentially even, taking it under. So those are things that, again, intuitively feel great, but actually you should, be very thoughtful about employing, and in many cases you should actually avoid because they could kill your startup.
One on the list that jumped out, first one actually, is elephant hunting. Can you speak to that one?
Oh, absolutely. Especially since I've, myself have done this mistake again and again and again, trying to hunt that elephant that, eventually you figure out you've spent all this time, all this energy, all this focus on a single customer or a set of customers that aren't actually going to make a significant dent in your business. So, I've had it myself. I actually talk from, firsthand at Life360, which is a company that I've spent 13 years building from, seed to IPO and beyond. We had one big sort of strategic partner somewhere along the way. That was ADT, the home security company. They invested $50 million in our company, and we did a big strategic deal with them. I mean, we had to kind of hunt them down with a bow and arrow for 2 years before we were able to get that kind of big strategic deal in place. And obviously, there was a significant investment there, but there was also a big project that we're working on with them, basically taking our company, Life360, encapsulating it and giving it to ADT so they can really kind of build almost like a parallel business, which is inherently crazy because you're powering a sort of a competitor, giving them the same capabilities that you have. But hey, we need the money. It was, significant amount of revenue. And what ended up with that story is that the commercial deal collapsed, right? They weren't really pushing it out. It didn't make a significant dent. We didn't get a lot of users. And later, because we did this strategic deal, our relationship with ADT was actually an overhead that complicated our lives when it came to potentially partnering with other folks like Amazon Ring as an example. So, we spent a couple of years trying to hunt down this elephant. We finally pinned them down. And at the end, it was actually, unproductive. It actually, sort of made things worse for us as a company. And I've seen this pattern again and again and again, where, sometimes it's much better to focus on scalable solutions that you can sell to a lot of small, medium, maybe even big customers instead of aiming all your arrows in your quiver toward like one single elephant that ends up not actually helping the business as much as you would like.
One of our founders was hunting an elephant recently, and a deal required 15 signatures in order to close from the customer. So not 15 approvals, but 15 actual signatures. They got 14, but couldn't get the 15th. The 15th guy at the customer was just intransigent. Good reminder of dangers of elephant hunting. I'd love to hear about boiling the ocean.
That's sort of one that I see with a lot of talented technical teams where they're like, often they have great technology, but they don't necessarily, have a business, right? And it's kind of sometimes we call it in venture a science project, right? Where it's like great technologies, maybe even a great product. And then because they have that great product and they believe in it, they kind of go out there and they try to see if they can apply that product, that feature, or that solution to anything that could create a business. And, obviously that doesn't really work, which is, in a lot of cases, I'm mostly a pre-seed investor. I know, Joe, you're a pre-seed investor yourself. We kind of want to see that a company has both, a technology, a moat, but also sort of a go-to-market and a business, um, and a business that can clearly define it and say, okay, like this thing, we know that this is a solution that clients want here versus, okay, we'll build it and then they will come and then trying to, again, boil the ocean to figure out if there's a there on this thing. So that's, to really build a business, you need to have both a great technology and a great business plan, right? At the same time.
AI is red hot with investors right now. How does that feel given you were ahead of the curve with AI? You were the guy that was going to the band before they got popular and had the t-shirt, and now they're on a world tour and everyone's following along. What does that feel like for you?
Well, honestly, I love it. Like I mean, generative AI is amazing in many ways. Obviously, it touches everybody around the world now with products like, ChatGPT and so on. But I think one of the things that people don't talk enough about is how much generative AI actually accelerated more traditional forms of AI that we've been developing over the last 25 years, right? Whether it's computer vision, NLP, which basically been replaced by the capabilities of LLMs. So a lot of the things that we were working on building in AI like a decade ago are now much more accessible, easier to build, easier to do, better, more accurate, right? It's very exciting times. I'm obviously a big believer. I've been investing in AI for over a decade. And I just kind of think like, obviously I'm very bullish. This is the tip of the iceberg. I think there have been like 3 or 4 major revolutions with technology. Obviously, the invention and the introduction of the personal computer is the first thing because that moved us from analog to digital, right? Like before the invention of the personal computer, everything was analog and then became digital. Everybody started having PCs at their home and they could, save stuff and so on and so forth. Then we had the invention of the internet and the significant extension of that through mobile, which gave the internet, like everybody's got the internet on the go. In cloud, obviously, is kind of another big dent in that crazy metrics of tech cycles. I think AI is as big as personal computing. It is a complete reimagination of human-machine interaction in the sense that so far we've had machines help us get more productive. Now we're going to have machines doing the job for us. That's a complete game changer. And there's probably trillions of dollars to be made in value creation over the next, decade or two. So I couldn't be more excited. And I'm kind of techno optimist in the sense that obviously there's a lot of things that we have to think about, right, in terms of how this changes us as humans, how we feel about work and business and our lives. But I'm optimistic in the sense that I think that this technology is going to elevate humanity to the next level, right? On so many different accords that I just, I wake up every day saying just like, bring them on. I'd love to see. There's so many amazing innovations that we're seeing now. And I think we're just getting started.
How do you feel about valuation with AI companies today?
Yeah, it's a little bit of the kind of have and have nots, if you will. So obviously we've had this significant hype cycle, which I think is still going on with LLMs, the LLMs themselves. They're a foundational technology. We've had significant excitement about the AI stack, all the way from NVIDIA, chip making to monitoring solutions and, kind of the entire infrastructure. And up until recently, we've been kind of behind on the application layer. And it's interesting because at least if history is to teach us a lesson, the application layer, that last mile, is where most of the value creation is likely to happen, right? the products and solutions that actually service customers and make them happy and help them doing a better job, right? So in the application layer, there's been a few breakouts. Obviously, things like Cursor and others. For folks that don't know, that those are applications that help developers be more productive and write code, or maybe even non-developers, right, can write code. Um, but in other areas, it's been. I'm not gonna say valuations have been low, but they haven't been as high as maybe some people have thought they would be. And I think a lot of that is because VCs don't exactly know what to do with this technology yet, right? They don't know how to approach it yet, so they're being careful. And most of the pre-seed seed deals that I see, which again are very early deals, I think are priced a little bit higher than what I want to see. Call it 8, 10, $15 million post-money valuation, but it's not out of whack. It's not crazy. It doesn't feel like a full-on bubble yet.
And typically, what's your sweet spot for how big the product is or how far along a team is at pre-seed? Because pre-seed is a wide tent of what people consider pre-seed.
Yeah, I think the definitions are hard, Joe. Like you nailed it. The definitions are hard. I think, and they also vary a lot vertical by vertical, right? I mean, just stating some things that might be obvious to some of our listeners. If you're doing a consumer company and you haven't done a consumer company before, likely you're not going to get significant funding before you can show traction because it's consumer, right? So you might be bootstrapping for a year or two, just building the product and showing that you can, get users to love it. Well, if you're spinning out of OpenAI and you're some researcher that is highly sought after, you could build a demo and people are going to throw money at you at $100 million valuation, right? So it depends vertical by vertical and kind of case by case. I think for me, where I feel comfortable is, first of all, I've got to feel really, really comfortable with the team. I got to feel really comfortable with the TAM, right? What's the addressable market? And I got to see that there's a defendable sort of a moat in the business. And if I see those things, I can go as early as inception, even though I don't do that very often. Or, it could happen at a later stage. Like even as a seed investor, I'm happy to invest in companies that have even multi-million dollars of ARR, as long as the valuation makes sense. So for me, it's actually kind of a very wide sort of set of options of stages, although my preference is obviously to be the first institutional investor where I can.
I heard an interview with Sam Altman a while back where he was talking about ChatGPT when it first burst on the scene a couple of years ago. And founders initially were, in his view, building around assumptions that ChatGPT wouldn't be able to do a lot of things in the future. And maybe an example of that would be all the text to image pitches that I saw around them, and you probably saw as well. But as time went forward, it became clear that the models would be able to do quite a bit more. And his pitch to developers and founders who are out there building is, don't bet on what we're not going to be able to do. Bet instead on what we're going to be able to do and what that can enable for what you're building. So with all that, it leads me to walk into a question you probably spent a lot of time thinking about, which is when you're looking at these companies, thinking about potential defensibility, what are the aspects, traits you're looking for where these companies can leverage, generative AI, the LLMs, the big models that are out there versus, becoming a feature of them in the future?
Yeah, absolutely. Absolutely. And I think, it's a very dynamic space and things are fast changing. I think we've gone from an era where we said, okay, maybe there's a world where ChatGPT does all of those things, to now we're seeing the specialization or sort of deep dive, even with some of those tools when it comes to specific use cases, right? You've got Anthropic Claude Code now. So there's like specific, they're building user experiences around code. And ChatGPT, OpenAI solutions, they're specific modes for when you're writing content, marketing, right? So you kind of see, and I think we're going to see more of that. But at a high level, the sort of big LLMs, I think they're going to try to, big LLM companies, they're going to try to chase the areas where there's massive value creation and they can tap into and maybe, disrupt or make a significant dent in big, audacious businesses like Google search, right? With obviously Perplexity and OpenAI, Anthropic, everybody's chasing a piece of that, search value pie. I think there are quite a few things. I know there's a lot of skepticism also in the investment community around can we create big companies in this era? And I'm again very optimistic about that. There's a couple of things that are going through my head, and some of those things are also the base of our AI moat thesis that we have at Recursive Ventures. So first of all, obviously, if you have proprietary data or you have unique ways of processing data, whether it's publicly available data or data that's not publicly available, maybe it's your customers' data, maybe it's a unique data set that you build through hardware, through partnerships, through integrations. There's a lot of ways to get that data that might not be available out there. You have a moat, right? Because we know that these AI models, those generative AI models, they're actually only as good as the underlying data, right? And how well that data is in terms of coverage of the use cases that the output of these models that the users require, right? So if you don't have the data, if the data is not good, you're not going to have a great model, or you'll have a great model, but it's not going to work the way users want. So that kind of proprietary data, proprietary ways of processing data, et cetera, I think that's real. I think I'm seeing that. I've got a bunch of portfolio companies that know how to do that. And again, it's not just like we have data that other people don't have. It could be as easy as like we know how to arrange it in completely new and different ways that make it much more conducive to be used with LLMs, right? So that's kind of one area. The other area is user experience. We're at a point in time where it's completely unclear how humans are going to interact with this technology, right? And we've already gone through a history in technology cycles where whoever is best at making a new technology accessible to consumers, to prosumers, to whoever is really good at finding that interface and making it the easiest, simplest for a user to be successful with this new technology has a good chance to win. Now, obviously, it's replicable, right? You can even copy user experiences as is, right, and just employ them in competition to a first mover. But I think it's more than that. It's a DNA, right? There's teams that know how to build great products, and when you play around with a great product, you know it, like you feel it. You know it's great, right? It does what you expect it to do. It works well. The quality is there, right? So I think that's another way to win. And I don't think OpenAI is going to create or recreate each one of those experiences, because it's like boiling the ocean in a way, right? So I think user experience is kind of another great way to win. And then the third one I would note is interesting is business model innovation. So we've gone through a period now where actually a lot of value creation in the previous cycle that for me started around 2010, 2012 and went all the way up to the tech bubble of 2020, 2021. A lot of what we've seen was actually not necessarily tech innovation, but tech combined with business model innovation. Think about Lyft and Uber and Airbnb, like all these companies, they didn't necessarily invent a new technology. They just like really figured out a way to sort of create a moat through business models. And we're seeing that as well now with things like services as software, where, obviously it remains to be seen, but maybe we've got a new party in town with this thing where, gosh, we can look at service businesses, consulting businesses, and transform them into, businesses that have a terminal operating margin that's similar to a software company. I don't know if it's going to happen, but it's a very interesting idea, right? So this is some areas where you can create a moat, I believe, and there's actually more. And I think through that lens, we're going to see immense value creation in AI sitting on top of these foundational models.
You mentioned Cursor earlier. My 11-year-old uses Replit. It's getting a lot easier for people to build these days, and it's only going to get easier. How do you think about that as far as distribution and standing out from the pack, the herd?
Yeah, absolutely. So basically, what are we seeing here? We're seeing that a trend where the cost of building software or building a website is kind of trending to zero in time as well. Now, obviously, with more complicated solutions, that's not going to be the case. But still, we're going to see a massive acceleration in your ability to iterate, push new stuff to production, get new features out, etc. I think that's very interesting. First of all, it democratizes entrepreneurship, right? We've gone from whatever, like 1998, where you would spend $50 million to build a website and be part of the dot-com boom, to, your 11-year-old. I've got a 12-year-old, same thing with Lovable, by the way, where it's like, yeah, this kid is now building things that, took 100 engineers to build in 1998, right? So I think it democratizes entrepreneurship and it creates massive competition, right? And in a way, in Silicon Valley, we've had this mindset of like, oh, execution is ideas are worthless. Like execution is king. I think I think this changes what we're seeing now. Changes the relationship between the two. I think great ideas that can scale up really quickly, and we're seeing that and create defendable brands that consumers like could actually win in this era. Um, because it's much easier to execute on those ideas. And we'll have this, billion ideas further out there on the wall, and we're going to see what sticks, right? So I think that's interesting, that democratization piece of it, right? Enabling anybody to be an entrepreneur. I think it has a massive impact on startups, the startup ecosystem, and venture capitalists, because I'm kind of wondering, and obviously, this plays to our business. I think that first check to start a company, right, a pre-seed company, that check that helps you leave your cushy Google job, I think that's always going to be there to a certain extent. But, because it's so easy to build stuff, I don't know if you need that $50 million check from Andreessen Horowitz. I really don't know, right? Um, if you can, there's this two charts now that are out there that have been built showing companies with under 50, under 20 employees, tens of $1 millions of ARR. And there's just like a year or two, right? There's a list of them now. And many of them are also not VC funded. You're like, maybe there's a different way to build scalable startups that doesn't require having all those VCs involved, which I think is interesting, is kind of poses a great threat for institutional venture. But I think, if you add it all up at the end of the day, it's great for the world, right? You have basically anybody can now create solutions, digital solutions that help themselves and help others. And I think we're going to see an explosion, a positive explosion of ideas and creativity like we've never seen before.
You're a solo capitalist. Recently announced you'd raised $30 million for Fund 3, which is amazing. Congrats. What led you to go the solo route versus joining a partnership where, given your background and how you performed with some of your earlier smaller funds, tremendous, you probably had a lot of different options, ways you could have gone. Why go the solo route?
Yeah. Mostly because I believe in the product, and the customer is the entrepreneur. And I think for pre-seed founders, especially repeat entrepreneurs, which I back very often, I'm kind of the best partner at the pre-seed stage, right? And look, I've been part of a bigger venture firm. I used to work in Morgan Terra Ventures, which is now called Canvas. It's kind of a storied Sandhill Series A, Series B fund. I was there 15 years ago as a junior guy, and I've seen how these guys operate, and I think it's great. I think those bigger venture funds, those partnerships, are awesome if you're investing in kind of Series A, Series B, and beyond stages, because I think these kind of stages are actually a different micro asset class than what is happening in pre-seed. In pre-seed, you need different GPs, different portfolio construction, and a different operational cadence. So, because pre-seed is really focused on people, right? And there isn't really 10 diligence calls that you can have with customers because the company doesn't have customers, right? And spending a week mapping the competitive landscape, having a bunch of associates do all this diligence work is probably not that helpful because it's new ideas, it's new disruptive ways of doing things. You're not like, obviously, if you see a company that does what, like starting, but replicates something that more mature companies want to do, that's not interesting. We're looking at new ideas, new technologies, right? Um, in a way, you can't diligence your way into understanding like having a crystal ball. It doesn't exist. Nobody has a crystal ball, and doing more diligence and having more people around the table doesn't always help. And I'll give you two examples, like two simple examples. Think about this. You're an entrepreneur, and I'm a consumer GP. I do consumer investments. You come and you pitch me, and we have all those conversations. Then I bring you a Monday morning meeting, and you're sitting there, and around the table, there's like 5 other partners, and they're all doing enterprise software. So they have no clue about your consumer business. They can't evaluate it. They don't have. And then you walk out of the room, and they vote on whether this company should get funded, whether it should live, whether it should die. And I'm like, what the hell? Why? How is that? It's almost like non-objective, right? Or, again, partnerships have dynamics, and maybe this investor is going to shoot down my deal because I shut down their previous deal, and all this politics comes in the middle. And like, why? I'm just like, as a pre-seed founder, I'm just busy like getting this thing off the ground, like getting from 0 to 1. So all this added politics doesn't help. And people like me who've been in the founder's shoes, right, from pre-seed to IPO and beyond, I think are the best buddies for this journey when you're starting a company. And that's why I chose to be a solo capitalist. Like you said, I have multiple other options that I could pursue, working with bigger funds, finding partners. But I think I have the best product for my founders. And I think I'm hearing it back from them as well, that this is what they want at the earliest stages.
Are you leading rounds or writing collaborative checks or both?
Both. Spend more time leading rounds with $750 million checks at the pre-seed stage. But I'm agnostic. It's really about the people and the opportunity.
Do you do much outbound to founders, or are you mostly working through them coming to you or referrals?
I very rarely do outbounds. I'm bombarded by deals. Just to give you a little bit of sense, I've done 172 investments in the last 15 years across my role as an associate at Morgenthau. Then I helped set up an incubator called Upwest, and I did angel investing, advising Fund 1, Fund 2, now I'm Fund 3. So I've been doing this for a while. And what happens, and then I have a venture partner that goes by the name of Constantine. He's one of the best angel investors in history. He invested in Tesla before Elon Musk, just to give you an example. Like one of the early investors in Canva. The guy invested in 21 unicorns over the last 25 years. And between the two of us, we've got more than 500 portfolio companies. So just imagine how many repeat founders we have coming back to us and saying, hey, I'm like building the next one. Or my star employee is thinking about starting something. Can you help them out? Like, can you talk to them? They're great, right? So we just have tons of inbound. And just to quantify it for you, I'm a data guy, so I keep like religiously tracking all this stuff. We get on average 3 qualified deals a day. A qualified deal is a deal that we get from somebody that we know and trust. This is not random. This is somebody that we know knows what they're doing. And it's either them or somebody that they know and trust starting this company. It's pre-seed or seed stage, so it's early, and it's got a significant piece around data and AI, which is really where our investment thesis is. That's a qualified deal. So we actually get 3 of these a day, including weekends, not just business days, which leads, to being very busy with inbound and just not enough time to do outbound. I wish I could do more outbound, but the reality is we just don't have enough time.
It's wildly impractical. I learned that pretty early on. I tried to make an effort to do it and learned that it was probably the worst return on invested time that I'd come across doing. Something I'm personally trying to find a balance on is how many meetings to take, like relative to qualified deals that I'm due. I'm curious where are you calibrated as far as first meetings relative to qualified deals you might look at or consider?
Yeah, I always I have a very institutionalized deal flow process where I do all of the screening at the top. Because if I don't do the screening at the top, what happens is the system gets flooded by all these opportunities. And then, when I start pulling in advisors and venture partners, I have two venture partners, it gets messy. So that's why, and it's also one of the advantages of being a solo capitalist is that I filter everything mostly from a time standpoint. Like, how do we save time? And this is actually very hard. Like, I'm not complaining or something. I love my job. I love helping founders, but I probably take 5 or 6 calls daily with new founders, like new ideas, new companies, which is a lot when you do it every day, right? Every business day. So 5, maybe even 6 a day of just like meeting new people, hearing about new ideas, evaluating whether we should pursue it or not, right? And I take that screening call, and if it's interesting enough, and the bar is very high, I got to be honest, the bar is very high. Like I try to do a service to the founders and just tell them if it's a no. I just tell them it's a no on the first call. I don't wait for the email. I don't because it also saves them a lot of time. Like, they shouldn't be investing in building a relationship with me when they're fundraising. If it's not going to be a yes, they should focus on other VCs that might get to a yes, right? Um, so so that's kind of the cadence. And then obviously before we make an investment, we can have up to 10 calls potentially with the founders. That takes a lot of time, but it's really where you want to kind of double down. So the trick is, from a time management standpoint, if you ask me, is filter very aggressively at the screening on a deck or the narrative, and then filtering again very aggressively on the first call.
How are you putting AI to work within your own firm?
Yeah, I love it. I'm this geeky guy who loves playing around with all this stuff. So I have a lot of projects going on. I'll share one which is exciting, and I'm also slowly opening it up to my limited partners. It's called Portfolio GPT, and basically I use Storytel AI, which is one of my portfolio companies. Storytel is really, really great in organizing all your stuff, so you can fit it into LLMs. Actually, any LLMs. It does the routing as well. Kind of figures out for you what's the best way to solve this problem, right? This project. So Portfolio GPT is where I put all my investment memos, all the decks of all the companies that are in the portfolio, and even those portfolio like company updates, right? Like, typically, founders send us monthly or quarterly updates, sharing how the business is going with their investors. So I put all that stuff in, and for internal use for now, that gives me the ability to ask any question about my portfolio, right? Spreadsheets included, so I can go and like ask something like, "Oh, like, what's the fastest growing company in our portfolio last quarter?" Bam, right? Or, what's in the competitive landscape of this company, right? Would this become, I can actually load another deck from a potential competitor and ask the GPT if it thinks that there's overlap, that this is a competitive to our portfolio company based on their updates. So if they pivoted, it would know that more recently this is a company. So there's a lot of stuff that you can do with that Portfolio GPT. I'm really excited about that project. It's one of the 4 projects that I'm doing with LLMs these days to get to what I call the AI VC, which I think gives us solo capitalists a superpower. Like, we don't need a team as much as we needed to have in the past because of all these AI tools potentially, which is a very exciting opportunity, I believe.
Yeah, I completely agree. I think if you look at the biggest advantages that large firms have, the first thing everyone points to is team, but that barrier has just been smashed. Like, what you've built there is as good as a small army of, junior associates out there hustling. No, that's fantastic. What advice would you have for someone who's thinking about making a career move into venture? And I asked partly off the back of, we're just talking about, you know, VCs are now using AI in the place of junior associates, and they're doing it a little bit now. I think there'll be a lot more of it in the future. How do you think about that for people who are trying to break into the space?
So look, I'm kind of opinionated on that. People can find my thoughts and musings on that online. I have, and my opinions are formed out of several beliefs that I have about venture capital. The first thing is, I think it takes 10 years to train a venture capitalist, like fully, which is a lot. There's a lot of training that needs to happen. The second thing is, I think it's very, very hard to win in this super competitive venture environment unless you have sort of the track record of building a big company, right? One of the things that I'll never forget when I was at Itamar Ventures, one of the partners there told me, look, like, even if we give you a $50 million checkbook to write checks out of, how do you think you're going to win a deal over one of us? And they were all amazing GPs, serial entrepreneurs with track records of taking companies public and so on and so forth. And, I was a junior guy and I was like, whatever, I'll figure it out. Of course I can do their job. Of course I can write those checks. But you know what? They were right. They were right. If at the end of the day, entrepreneurs, good companies, they have a choice on who they want to partner with on the investment side. And if you haven't been in their shoes, if you haven't built a significant business, you're at the disadvantage compared to somebody like me. Like, when I talk with founders, I'm like, yeah, I've been in your shoes, and then I took it all the way to public and beyond, right? And so I think what a lot of people get wrong about venture is that, and I mean, it's out there, people know, is that if you start as a junior VC, your chances of moving up the ladder, like you do in investment banking, for example, are actually super small. We hear about the examples of somebody who got this associate job and then they hit this amazing unicorn investment and they got promoted due to that. But that is adverse selection. We don't hear about the 95% of associates that got, pushed out after 2 to 3 years, which is typically what happens in venture. So my advice for people that are thinking about venture is actually the following. I was like, this is a great idea. You should pursue venture as a junior person, but with the mindset of doing it for 2-3 years. Your learning curve will flatten very quickly, and then leverage that as a way to find a great position, probably an executive one, in a startup that you have now, that inside out. They're a portfolio company. You have a great sort of overview of the industry. You know who's doing what. You know what's interesting. And that's a perfect position to jump into a startup at a senior role and be successful. So leverage venture to do that, right? To find the next big opportunity for you in startups. And I think for that purpose, venture is a great, starting point. So that's what I typically advise folks that think about more junior folks thinking about going into venture.
When you don't win a deal that you want to do, what is the reason you get these days?
It happens. It doesn't happen as often as people think. I get this question a lot, but it happens. Part of why it doesn't happen a lot to me is because I'm flexible. I don't have to lead, so I can write a smaller check if there's a bigger lead that comes in. But I definitely do lose some deals because of valuation, right? Somebody else comes in, offers this crazy. I just had this thing a couple of months ago. It was crazy. Amazing repeat entrepreneur, gave them a verbal offer for like a $3-4 million round. Obviously, I'm a small part of it, but still kind of lead it at, let's call it a $20 million valuation. Some other VC comes in, gives them $12 million on 60. And the company hasn't even started, right? So there are instances like that where I get outbid, I guess, on valuation. There are instances where I think the founders maybe want to have a different VC. Maybe that VC has subject matter expertise that I don't have, so they would give them priority over me. But overall, it doesn't happen often, which is obviously good news for my business.
For sure. What's a question you love to ask founders?
I spend a lot of time digging into moat and differentiation. So we're obviously in venture, early stage venture, we're trying to look into the future. So I asked them, 5 years from now, why would you be 1 year ahead of the competition? Right? And because today, explain that to me, but help me understand how that unfolds. Like, how would you always be ahead of the competition? And this is, especially at this age, we just talked about AI, how easy it is to build stuff. I think that's going to be the question that differentiates the winners from the losers, right? Because it doesn't matter at which stage you're at. You could be you could be a public company. If you can't fend off the competition, if you can excel and deliver more than they can systematically with a big company, with a small company, with your organization, with your technology, then the music will stop. right? It doesn't matter if it's public or seed, it's just the music will stop. And when we're making those bets, Joe, in venture capital, which you and I are betting on, we're there for the long run. And we want a company in which the music never stops, right? Like 20 years from now, it's a $20 billion company and they're ahead of the game, right? So that's probably the question I almost always ask.
What's a conventional view in venture that you think is BS?
Oh, wow. This is a tough one, but I'll give you one that's contrarian, that venture capitalists are value add. I think most VCs are not value add. I think we are delivering capital, which is key to scale these businesses, to build and scale those businesses. And I think a bunch of the added services that many venture firms promote are not really valuable. And I think founders get it. Like in the beginning, I remember 2012 maybe, when Andreessen was on a swing and they did all this recruiting and hiring for startups. And people were like, yeah, I've got Andreessen Horowitz hiring execs and engineers for me. And, 10 years later, I'm not, they're obviously still doing that. And I'm sure there's some happy customers, but a lot of founders that I talk with are like, yeah, I'm still hiring most of the top people myself, right? It's not like, so I think those value added services are at best overhyped.
I'm sure there are no VCs out there whose feelings are hurt with that. Last one, anybody out there, particularly founders who listen to this, would love to connect with you. What's the best way for them to do that?
Get a warm intro. It sounds bad. I can't put my email out there because thousands of people would reach out. And I want to talk to all of them. There's only so many hours in the day. So the best way to approach me would be find somebody who knows me and knows me well. I've got 20,000 connections on LinkedIn. And I know a lot of those people, believe it or not. And have them, vouch for you, then connect you to me, right? That's by far the best way. Probably the second best way is to engage with my content on LinkedIn and Twitter, right? If you have thoughtful responses. And sometimes I do stuff like I just launched this 10 100K no hustle consumer AI checks, right? So I would write 10 100K no hustle, one meeting checks, 100K checks. So there's a thread there, hundreds of comments. If you post in a very thoughtful comment about the company that you're building, I'll talk to you. Like I'll try to engage with you publicly, privately to understand what you're building and see if I can be helpful, right? So engaging with my content is probably the second way.
Awesome. Well, Itamar, this is really fun. I really appreciate your coming on.
Thanks, Joe. This is great to be here. Super enjoyed it. And thanks everybody for listening.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.